Here's a number that should stop you cold. A single AI server rack in 2026 will pull around 120 kilowatts of power. That's not a typo. A few years ago, a standard rack used maybe 5 to 10 kilowatts. We've gone up more than 10 times. And to move that much electricity without melting the silicon, every one of those racks needs hundreds of tiny power management and voltage regulation chips that almost nobody talks about. Nvidia gets the headlines. Nvidia gets the $1 trillion valuation. But the unglamorous little chip that actually delivers clean power to that GPU, it might be the smartest place your money goes in 2026. Let me show you why. So everyone is piling into the same 4 or 5 names: Nvidia, AMD, Broadcom, TSMC, maybe Micron. And look, those are real businesses. But when a stock is already priced for perfection, your upside gets compressed. You're buying after the easy money's been made. The smarter play, the one professional fund managers actually run, is to go one layer down the supply chain to the components that every single AI chip physically cannot function without. That trade at a fraction of the valuation and a fraction of the share price. Think about what a GPU actually needs to run. It needs power converted from the wall voltage down to under 1 volt, delivered with surgical precision, hundreds of amps, switching millions of times per second. It needs heat managed. It needs data moving in and out. Each of those jobs is owned by specialist companies most retail investors have literally never heard of. That's our hunting ground today, 5 of them. Let's go. Point 1, power management is the new bottleneck, and monolithic power systems is the name to understand. Ticker MPWR. Now I'll be straight with you. The share price isn't $3, it trades much higher, but stay with me because the principle matters and we get to cheaper names. Monolithic makes the power management integrated circuits, PMICs, that sit right next to the GPU and feed it clean, stable voltage. Here's the actionable insight. As power per rack explodes from 10 kilowatts to over 100, the dollar content of power chips per server goes up dramatically. Monolithic's data center revenue has been growing faster than the GPU market itself because each new generation of chip needs more, fewer power components. That's why when you research any AI supplier, that's the metric to hunt for. Is their content per server rising? If yes, they ride the wave twice. More servers and more chips per server. Point 2, this is where the $3 idea gets real. Look at Navitas Semiconductor, ticker NVTS. This one actually trades in low single digits. Navitas builds gallium nitride and silicon carbide power chips. Here's why that matters. Traditional silicon powered transistors waste energy as heat when they switch. Gallium nitride switches faster and runs cooler, which means you can deliver more power in a smaller footprint with less loss. In a data center where you're paying for every watt and fighting every degree of heat, that's gold. In late 2024, Navitas announced a collaboration with Nvidia on 800 volt high voltage DC power architecture for next gen AI data centers. That's the kind of catalyst you want to find. The actionable lesson: small caps like this are volatile and speculative. You size the position accordingly. This is not where you put your rent money. It's an asymmetric bet. Small position, big potential. And you accept it might go to 0. That's how you play the bottom of the supply chain. Point 3, never forget the analog kings, Texas Instruments, ticker TXN, and Analog Devices, ADI. These aren't sexy. They aren't $3, but here's the thing professionals know. Analog and power chips don't get obsolete the way digital logic does. A power regulator designed today might sell for 15, 20 years. That creates incredibly sticky, high margin revenue. Texas Instruments runs gross margins around 60% and pays a real dividend. The actionable framework here: in your portfolio, you want a barbell. On one end, the speculative Navitas style moonshots. On the other end, boring, cash gushing analog compounders like TI that pay you to wait. Most retail investors own neither. They own the hyped middle. Be different. Point 4, the connection layer. Every AI chip has to talk to other chips at insane speeds, and that's where companies like Credo Technology, ticker CRDO, come in. Credo makes active electrical cables and serializer-deserializer chips that move data between servers without errors at very low power. As AI clusters scale to tens of thousands of GPUs talking to each other constantly, the interconnect becomes a bottleneck just like power. Credo's revenue has been exploding off a small base because hyperscalers need their tech to keep clusters from choking on their own data. The actionable takeaway: follow the bottlenecks. Wherever there's a physical constraint on scaling AI, power, heat, data movement, there's a specialist company solving it, and that company captures pricing power. Map the bottlenecks, find the supplier, check the valuation. And the last one, I saved it for the end because most people genuinely don't know this yet. And it's the kind of edge that separates people who read headlines from people who read supply chains. Point 5 in the deep dive: it's not a single stock, it's a hidden choke point. Substrates and advanced packaging. Here's the secret. As chip makers hit the physical limits of shrinking transistors, the next wave of performance doesn't come from the chip itself. It comes from how chips are packaged together. This is called advanced packaging, and TSMC's version is called CoWoS, chip on wafer on substrate. The entire AI boom is currently rate limited not by how many GPUs TSMC can etch, but by how many it can package. And inside that process sits an obscure material called ABF substrate, made by a tiny handful of companies, mostly in Japan and Taiwan, names like Ibiden and Shinko. These are the actual physical choke points. When you hear that GPU supply is constrained, 9 times out of 10, the real constraint is substrate and packaging capacity, not silicon. So here's your edge. When an AI hardware company reports earnings, don't just read the headline number. Listen to the conference call for the word packaging or substrate or back-end capacity. When management says packaging is easing, that's a green light for the whole supply chain. When they say it's tightening, that's your warning. The bottleneck is shifting. You now understand something most people buying Nvidia at all-time highs have no clue about. Let me tie this into an actual strategy you can use this week. First, build a watch list of the supply chain layers. Power, like Monolithic and Navitas, analog compounders like TI and Analog Devices, Interconnect like Credo, and packaging, the Ibiden type Chokepoint plays. Second, for each one, ask 3 questions. Is content per AI server rising? Is the valuation reasonable versus the hype names? And is there a named customer relationship with a hyperscaler or with Nvidia? Third, size by risk. I mean, where we see boring compounders get the bigger allocation, the $3 speculative names get small, defined bets you can afford to lose entirely. That structure means you participate in the AI build out without betting everything on one already expensive stock, catching every quarter perfectly. One more reality check, because I respect you too much to hype you. Small chip stocks are brutally cyclical, they run hard, and they crash hard. Navitas type names can drop 40% on one soft guidance. So this is not a get rich quick list, it's a get positioned early framework. The people who made fortunes on the last semiconductor cycle weren't the ones chasing the obvious winner at the top, they were the ones who understood the picks and shovels and bought them when nobody cared. In 2026, the picks and shovels are power chips, interconnects, and packaging. That's the whole thesis. If this gave you an edge, smash that like button. Subscribe to Alpha Protocol for your daily drop on AI, crypto, and finance, and drop a comment. What do you want me to break down next?